If you want to invest like a pro, stop asking, what's the next hot stock? Pros don't buy tickers, they buy businesses. And they don't fall in love with headlines either. They score the business, fast, consistently, and the same way every time. In this video, I'll show you a simple pro-style framework, a 4-bucket scoreboard: growth, profitability, cash, and risk, with valuation as the final filter. Because investing isn't about news, it's about the quality of the business you're buying. When I say read a stock, I don't mean memorizing a ticker symbol or watching price charts all day. I mean reading the company behind the stock. A stock is a claim on a real business, its sales, its costs, its cash, and its future. So reading a stock means answering a few core questions. Is the business growing? Is it profitable in a durable way? Does it generate real cash or just accounting profits? And what could break the story? Most investors start with news and opinions. Pros start with fundamentals and a process. That's why they use scorecards. Not because they're perfect, because they're repeatable. Here's the idea. You score the business in 4 buckets, not with complicated math, just with structured thinking. You can use a simple 0 to 5 score per bucket. The exact scale isn't the point. The point is, you don't let the loudest headline decide. You let the business performance decide. And once the business earns its score, then, and only then, you look at valuation to see if the price makes sense. So let's build the scoreboard. First bucket, growth. The question isn't just, is revenue going up? The question is this growth real, and is it repeatable? Because growth can be high for bad reasons: temporary hype, price increases that customers won't tolerate, or aggressive discounting that kills margins. So you're looking for the engine of growth. Are they selling more units? Expanding into new markets? Launching products that stick? Or are they just pulling demand forward? Pros love growth, but only when it comes with consistency and clarity. Because sustainable growth is the first signal that a business has momentum, not just a moment. Second bucket, profitability. Growth is nice, but profitability answers the harder question. Does this company turn sales into real economic value? Here you're watching margins and what they imply. If margins are improving, it often means pricing power, scale, or operational excellence. If margins are shrinking, something is pushing back: competition, costs, or weak demand. And the key phrase is durable profitability. One good quarter doesn't mean much. Pros look for a pattern. Can this company defend its margins when conditions get tougher? Because in the long run, the market doesn't reward stories. It rewards businesses that can keep earning. Third bucket, cash. This is where amateur analysis often breaks. Because a company can show profits and still be a cash machine in reverse. So the question is simple. Do their earnings turn into cash, or do they constantly need funding? Cash matters because cash is what allows a business to breathe, to reinvest, survive downturns, pay down debt, buy back shares, or pay dividends without borrowing. If profitability is the promise, cash is the proof. And if cash generation is strong, the business usually has real flexibility, which is one of the most underrated competitive advantages. Fourth bucket, risk. Now we ask the uncomfortable question: what can break this business, even if the numbers look good today? Risk isn't the stock went down this week. Risk is the chance of permanent damage. So you scan for things like too much debt and expensive refinancing, dependence on one product, one customer, or one market, cyclicality, where earnings collapse in a downturn, regulatory exposure, geopolitics, currency shocks, and dilution, when shareholders get quietly watered down over time. Pros don't avoid risk, they price it. But first, they identify it, before the market forces them to learn it the hard way. Now, valuation. Notice what we didn't do. We didn't start with valuation. Because valuation doesn't tell you whether a business is great. It tells you whether a great business is already fully priced in. A wonderful company can be a terrible investment if you pay a price that requires perfection. And an average company can be a good investment if expectations are too low. So think of valuation like this. The scoreboard tells you the quality of the business. Valuation tells you whether you're getting a margin of safety or whether you're buying a dream at peak optimism. Here's how you use this in real life. Fast. 1. Growth. Is the business expanding in a way that looks repeatable? 2. Profitability. Are margins solid and resilient? 3. Cash. Does profit become cash, or does cash disappear? 4. Risk. What's the one thing that could break the thesis? Then, valuation. Is the price reasonable given the score, or is there no room for mistakes? And here's the best part. If you can't answer one of these questions, that's not a failure. That's your roadmap for what to research next. So remember, investing isn't a news reaction game. It's a business scoring game. Use the 4-bucket scoreboard to stay disciplined, objective, and consistent. And use valuation as the filter that protects you from overpaying. In the next episode, we'll go deeper into growth, the key metrics, the biggest traps, and how pros spot fake growth before it shows up in the earnings call. If you want that breakdown, subscribe and bring a stock you want to score.